Welcome to our CFA members and all of our guests to another issue of Macro Matters. Here we are on July 31st. We are after the most recent FOMC meeting, and we can talk a little bit about that. And we're before the August 1st tariff deadline, so that we'll certainly probably talk a little bit about that. My name is Rich Excell. I'm your co-host as usual on Macro Matters, and today I'm joined by Blaine Reed, our co-host of the last several episodes of Macro Matters. Uh, Blaine, welcome. Thanks for coming. Thanks for coming in. It looks like we've got Tony Zhang, the other co-host, coming in hot. He's joining us right now. So, how you doing today, Blaine?
I'm doing good, Rich. Good to see you as always. Glad to be here. Looking forward to the discussion. Hi, Tony.
And good morning, Rich. Blake. Yes.
Yeah. So
This is
we're live and we're going and you're coming in hot, Tony. So we're just gonna like see off the cuff what you're thinking about the things that we're talking about. Okay. I know you are Mr. Rate Cut. You are definitely on the side of the president and Congress, it seems. And Blaine and I are going to make the case again for how Jay Powell might actually have it right this time. So again, as I said, we are after the FOMC. And as we know, the Fed has a dual mandate, right? They have a mandate of prices and jobs. And if we look at the data that's come out today, we got PCE data out today, and it corroborated really the CPI data that we got a couple weeks ago, and where both the headline and the core on a year-over-year basis are worse than expected. They're still, I mean, the core for each of them, both CPI and PCE, in the 2.8, 2.9% range year over year, well above the 2% target. The chart I have up here today is looks at the M2 index, which is not only well above trend. I've drawn a 10-year trend line down there. It's well above trend, but it's also turning higher and continuing to move higher. Is and as Milton Friedman always told us, inflation is always and everywhere a monetary phenomenon. So maybe the fact that we have too much money and growing amount of money is leading to sticky prices. Blaine, I don't know what you think or what your initial reaction was when you saw the inflation data come out today.
Yeah, so my initial reaction is unchanged from kind of what I was thinking the last time that we got together, and that is, I think the Fed is going to take a little bit of a wait and see approach here, and maybe we're starting to see. I think Jay Powell mentioned this yesterday, but we're starting to see some of either the commentary or the actual numbers of some of these tariff impacts start to kind of roll through in some of the pricing. And I just think they want to wait and see how sticky that is and to what extent they uh, that impacts pricing. And when you get data like you do this morning with PCE, not only is it higher than the absolute 2%, it actually came in a little bit higher than expectations. So I think that all bodes for a continued wait and see approach. I think we saw that a little bit in the Fed funds futures, where the expectations for a September rate cut diminished a bit. I think inside of 50% now. So I guess my initial take was kind of right where I thought we'd be, and that is kind of holding steady for now. So
Yeah, for sure. And there was an interesting report put out by Piper Sandler, Nancy Lazar and team at Piper Sandler. They're probably my favorite economic macro team on the street for sure. They looked at the tariffs and who's paying the tariffs, right? They looked at what goods have been trading this year, the prices at which those goods are trading, and essentially they broke it down and they found that 90% of the tariffs are being paid by the US, 60% by companies, 30% by consumers, and only 10% is being pushed back into the supply chain. And so it definitely would suggest that it's not other countries but the US that is paying these. Um, they took great pains to say that they don't see tariffs as inflationary, though. They see it as a tax. They see it as a one-off price adjustment that's a tax. And so maybe that would feed into the rationale for cutting rates, Tony. When you see this inflation data, when you go out to the restaurant, when you go to the grocery store, all you're thinking to yourself is, wow, this inflation's really coming my way. I've got to cut rates soon. Is that how we're going?
well, uh, definitely different from what you just say. It's like by just looking at the CPI data, apparently, especially the core CPI data released early this morning, but that actually supported Fed to take a wait and see approach. But if we actually re-listen to what Chairman Powell just say yesterday, apparently what the market really um, focus is whether the Federal Reserve would actually like to take a more of a flexible approach, just maybe by having some kind of preempted cut just before this kind of a data getting worse and worse. Just by taking maybe a forward-looking approach. This is what market really focus on. And apparently, no one expected Federal Reserve to cut the interest rate in July, right? It
Right.
was a rare move that the market would anticipate that. But now here it's the market would look at how the Fed would actually do like in September and August meeting initially. Apparently the market anticipated Federal Reserve would at least cut 25 basis point in September and another maybe 25 basis point in October. That was the initial plan. But however, the thing was that just by looking at listening to what he say, apparently he tried to convince the market that the past of this monetary policy was uncertain, and he does not know. So this is actually really the puzzle me and I think a lot of economists. So apparently, tariff bringing the uncertainty might be a good way and good argument before, but based on what we have achieved recently, that um we actually make a deal, and President Trump make a deal with the EU, unprecedented, and making a deal with the Japan, so which was very unexpected, right? And making I think another deal with South Korea as well. So that actually removed the tariff as a roadblock as uncertainty just by from a market position of institution perspective. I think this is really help. That's why even yesterday when it actually went down initially, and now here it actually just come back up very nicely. But come out nicely, just lifted by major company. However, that actually is that's really should tell us that the tariff should not be a counter argument for the rate cut. And I continue to hold the belief that the AI innovation is accelerating and accelerating at a speed that Federal Reserve will not actually prepare for that. And the AI innovation by nature is deflationary. That's why even though maybe we have already seen like a inflation in place, also the tariff in place for over 6 months, but we haven't really seen the CPI. This is like a skyrocketing the too high, maybe core CPI 2.8 above the 2%, the average rate that Federal anticipated to see. But I'm thinking that might be just in the new norm. And given the nature of AI advancement, I think we are going to see more of the layoff from the large corporation with high pay, and those jobs. Um, uh, the middle class, like high paid job or high end or the upper class of the paying job, and with them being laid off, we'll see the purchasing power from the middle class would actually decrease. That's actually also a deflationary factor. So with all of these things, I actually continue to argue that we should actually have the rate cut and faster than better to actually hold the current the economic development. And another concerning factor apparently is in the real estate market, as every people know, right?
Yeah.
We have
Well,
a
let's get to that, but let's talk about the jobs first.
yes.
We have some housing data to look at.
I think yeah, I
I'm
think
glad you
this
got to talk about the jobs because this is something I looked at yesterday. I mean, everyone's going to focus on the non-farm payrolls numbers tomorrow.
all right.
I never understand why we focus on a number that's subject to so many revisions and is really generally useless. But we've got a lot of other jobs data this week. We got jobless claims today, and here if I look at the internals of that, I'm looking at a ratio of the continuing claims to the initial claims, and so that logically and intuitively, when people are sticking on the jobless claims payroll longer as a relative to the initial claims, that's a sign of weakening. And you can see that it has been getting weak, weaker. I mean, we've been at these levels before. It's not an unprecedented amount of weakness, but it's getting a little bit worse. And then the blue line, maybe this is more to your point, is is the conference board data that's came out. It's the jobs hard to get versus jobs plentiful. So it's harder to get a job than it has been. And I look at both of those relative to the unemployment rate, and the unemployment rate lags them. And so this would seem to suggest the unemployment rate will be ticking higher, and that jobs, the conference board data, that jobs hard to get versus jobs plentiful is that is the corporate jobs you're talking about. That's probably the more middle, the upper income, white collar type of jobs, whereas that jobless claims data tends to be a little bit more dominated by construction and retail and manufacturing and a little bit more blue collar. But on both of those fronts, clearly things are getting a little bit worse, but they're not to the point to where the Fed needs to panic and preempt anything. They're just normalizing, if anything. And then I would say some other jobs data we got the JOLTS data here. I'm looking at the job opening and labor turnover survey. It came in weaker than expected, but if I look at the trend over the last 10 years, which I have the the average line over the last 10 years, it's really just getting back to pre-COVID levels, right? After COVID, when there was that massive shortage, we saw a huge spike in the job openings, and it's really just normalizing back to pre-COVID levels. And then the Challenger layoff data, which came in, a lot of people talked about that. They came in worse than expected this week. You can see it is definitely worse than expected, but it's not that much above trend, right? We see these spikes as well. So clearly the labor market, to your point, Tony, is getting a little worse, but it's not at the point of panic yet. And the Fed, which is data dependent, which by saying that they're data dependent tells you they're not going to be preemptive, they're going to be reactive. It doesn't seem that on a dual mandate of price stability and full employment, it doesn't seem like they have any real reason to want to rush into cutting rates.
I would just on that note, because with your charts and the argument that Tony's making on the jobs, you can see that obviously in the charts, and you can argue one way or the other whether we're at that point of needing to be preemptive or not. But I think when you have a dual mandate and one signal's giving you potentially inflationary signals and the other is giving you potentially a slowdown in the jobs market, it makes it hard to be preemptive, um, because you which one are you going to favor? And and he said something to the effect yesterday that you could argue that we're being preemptive now by not raising rates. And you know, that I don't know that anyone was expecting him to say that the Fed being preemptive is keeping things the same. And so I think it tells you where their mindset is at, is they got to balance both of these. And one part of the equation says you could be preemptive and raise rates, and the other part is saying you could be preemptive and potentially lower rates. And I think it just, as you said, Rich, argues for being kind of a little bit reactive and seeing it in the data.
This
Yeah,
this
I think yeah.
Sorry, John, one thing. This goes back to what we were talking about a couple months ago, where the data is looking maybe arguably somewhat stagflationary. And if you look at what Piper was talking about on that tariff data, where companies are going to maybe are eating a big portion of this and it's going to eat into their margins a little bit. Now, of course, they got tax breaks that help them offset some of that, but there could be a slowdown as higher prices will reduce consumption on some things, but price levels could, at least on a shock level, still stay higher. And I remember the Federal Reserve, the St. Louis Fed president said that in a stagflationary environment, they would basically rely on consumers, inflation expectation data, to tell them what they should be doing. And the inflation expectation data has suggested that consumers are more worried about price levels than they are about their jobs, which would suggest that maybe hiking rates versus lowering rates would be more of a bias. But Tony, we'll give you the say there. Sorry.
Well, yeah, that definitely. I agree. Your both of your reasoning and arguing like to for the Federal Reserve's current policies. This is no doubt. They are absolutely correct. But here is one thing that we need to pay attention to. Here we are actually living in a very highly unusual environment in which we see the like both geopolitical uncertainty and simultaneously we have the historical high national debt with extraordinary historical high interest payment over the debt. And, meanwhile, we also see that the large corporation, which actually tend to actually hire more and more people, and is still making historical high of a profit and simultaneously laying other people. That actually telling us this is things that we shouldn't actually just looking at the using the historical approach. Even further with the dual mandate, one is apparently to be responsible to making sure that the economic is strong, to have a high to low unemployment rate, which actually we definitely seen it here. And I think yesterday, Chairman Powell signaled that if there's any increase over the unemployment rate, that he would take the responsive approach, as Richard already just mentioned. But I think here, if whenever the federal responds, I think it might be just too late because the acceleration, the replacement impact of this AI revolution, I think it's something that it's very difficult to predict, and it just happen on a daily basis. And the other is about the inflation and the CPI data, geopolitical, the CPI data coming up today due to multiple reasons, but major factor that what we have seen include, for instance, like the energy expense decrease. Maybe the food expense goes slightly higher. I mean, because of some kind of a maybe disease or some kind of a tariff or any control between across the border between the U.S. and Mexico. But I see the weakening factors like playing out. There's a foreseeable future, and given the current high interest payment that the whole country had to pay, this is I think we should actually lower the interest rate cap here to support to really prevent a disaster from happening. This is because we just do not know where the issues could happen. But if we just taking a responsive approach, just add what Chairman Powell suggests yesterday, whenever that happened, it could just market would anticipate, market would interpret it as like Fed was actually slow in response, and historically that was always the case, right?
Yeah, no, I hear you. So here I've just brought up where where the bond market is thinking Fed's going to cut. I mean, if we go out to the end of the year, we see 1.38 cuts, right? You don't get two cuts until somewhere
Yeah.
in Q1. If we go back a month on this data, you would see at the end of the year the bond market had almost 2.7 cuts before, and they had almost four cuts by Q1. So we've taken out all one and a half, probably one and a half rate cuts over the next several months. So the bond market is kind of seeing the Fed saying, the Fed doesn't look like they're going to cut. And, the bond market is finally coming around to the views that Blaine and I have. Finally they're getting smart. But I guess, but Tony, to your point, there are parts of the economy that clearly could use lower rates, but there's parts of the economy that clearly don't need lower rates. This is the money market mutual fund assets, which over $7 trillion of money market mutual funds. This is up almost 50% from a couple of years ago. These are baby boomers sitting in cash, earning 4%. Um, you know, these are the people that tell you that they don't need rate cuts. In fact, they would love to have rates stay where they are. They love them at 4% because they can go and spend their interest on their restaurants and they're helping the economy. And that's probably leading to why there's so much money sloshing around the system is because you've got this. Now on the flip side, we could look at mortgage rates, right? That's the millennials and that are saying you got to lower rates because we need to be able to buy a house.
Yeah.
And we can see that mortgage rates are at 6.8%. The 30 or the 20, there's 30-year trend or average is somewhere around 5.25, 5.3. I see a lot of people on Twitter talking about why aren't mortgage rates back at 3 or 4%? I mean, that was a historical anomaly to think that we're going to go back there. If we go back there, I'm going to guarantee you that no one's going to want to buy a house because that means the economy is in such bad shape. Um, but a lot of this spread here, the 150 basis point spread, isn't because it has anything to do with the Fed, right? The Fed only controls short-term interest rates. It's the market that controls long-term interest rates. And if we look at what this is the spread of the 30-year mortgage to the 10-year treasury. So this is basically, to me, the willingness of banks to to make a mortgage loan. That spread historically is around 175 basis points, has been through time. It's come down to about 250 basis points. For a while there, it was up around 350 basis points. And so 75 basis points of that 150 or so on the mortgage is really because banks don't want to make loans right now, right? Because from an affordability standpoint, if we look at it, affordability, which has gotten a little bit better on this last chart, affordability has been, very, very poor. And a good conference call I listened to suggested that for affordability to get back to where millennials can afford to buy houses, you either need a 25% correction in prices or you need 100 basis points on mortgage and an 8% correction on prices. So, either it's really has a lot more to do with house prices and the lack of inventory than it does with the Fed and mortgage rates. And that it's not even entirely clear that if the Fed lowered rates, mortgages are going to come any are going to come lower, because let's not forget, if we look at that the mortgage rate, the Fed last year, end of last year, cut 100 basis points in Q4 or Q3, Q4 last year, and mortgage rates are the same. And so arguing that the Fed cutting rates is going to help mortgages, I think is a little bit of a specious argument. But maybe Blaine, I'll pass it to you first and see what you think about all the stuff there.
Yeah, no, you hit a lot of good points there, Rich. I think the one that sticks out to me is potentially the inventory issue. Been reading and hearing a lot about the increase in inventory and just the lack of the slowdown on home prices or homes moving. And maybe we'll start to see some of that deceleration in pricing, or at least slowdown in pricing increases, maybe some price cuts, and that might help that spread that you were showing earlier, because we've certainly had an increase in asset prices as it relates to home prices over the last several years. But so that's one thing I've been hearing about and paying attention to, reading about, is just the level of inventories. And we might be at a point where the sellers now have to take some price cuts to get some buyers to step in. So
Yeah. So, and Tony, this is something that Blaine pointed out before. I
mhm.
brought up an M2 data, M2 index point, and he said, "Well, what about velocity?" And
Yes.
so you can see here, here's the velocity is in orange, and the velocity of money, it's a little above the COVID type levels, but it's still fairly low historically. The other data points I have on there is a little bit of a busy graph. I have banks' willingness to make loans, and I have small business loan index, and you can see that tracks pretty closely. The banks have gotten a little bit more willing to make loans in the last couple of years, and small businesses are feeling that a little bit better. But the one thing that stands out that's really holding down velocity is this mortgage data, right? This is the Mortgage Bankers Association purchase data, which is at century lows, right? It's at the lowest of the 21st century. And so it really seems that the rate argument entirely, to me, kind of hinges on the housing market. And then and I just, to me, I don't see where necessarily the Fed has a direct impact on mortgage rates. That's really more what the market and what the banks themselves are willing to do. But I'm open to hearing arguments.
Yes, I definitely agree with what you just say, and also Blaine pointed out, and it might be suspicious that if Federal Reserve really cut 100 basis points, whether the market rate will actually decrease, and at this moment that we should actually relook at the supply and demand of the market at this moment. Do we see the structural imbalance like within the housing market, especially in the area like coast area, West Coast and East Coast, plus some area within the Texas, and those places where we actually see the booming real estate market over the past 5 years since COVID, right? Apparently, no doubt. Of that. But here, the couple reasons actually happened that caused the right now the slowing of the market rates application number here. One, apparently the real estate price was so high, and even by looking at the current like interest rate, is we typically within the housing market, people look at the cap rate. in basically by comparing like you're investing into the real estate versus like you're just putting the money into the cash to earn
Yeah.
the.
Well, he froze it, but I think to Tony's point, he was going to say, I mean, I've seen the data that along those same lines, it is much more appealing and much more affordable to rent versus buy right now, right?
Yes, yes, and then also more importantly now here is that if people are the real estate price right now is just too high, so I really actually had to come down to the points like either the income for the people or had to go higher, or the price of the house had to come down, and it might actually take a recession for the house price to really come down because right now, given the unemployment rate is at historical low, and I do not see it as like that's going to happen soon. So it is like a housing market. I think it might be just getting slowing down, in trending down at this moment. This is just my uh, uh, prediction, and by looking at all kind of market application data and the housing market in different area.
Yeah, I wouldn't disagree with you. And you mentioned recession and the if we look at the yield curve, the 2-year, 10-year, and I have it up here in blue. It's it's moved back. It's steepened back above zero. And historically, the yield curve tells you we're going to have recession when we move back above zero. We've talked about that. And the other line I have on here is the what I call the Jay Powell recession indicator. I think in his speech about 3 years ago, he mentioned 3 or 4 years ago, he mentioned that he felt that the best measure wasn't the 2-year, 10-year, but it was the 3-month yield, 18 months forward, less the current 3-month yield.
Oh, interesting.
Because that's what his argument was that the market is indicating that there's going to be a slowdown and a need for the Fed to cut rates, and that's what he was looking at. And there have been two Fed research papers that support the fact that this 3 months, 18-month forward versus less 3 months is actually a better yield curve indicator for a recession than even the 2-year versus 10-year. And that's the line I have in orange. Like whenever that line is negative, it indicates that there's a potential recession, and that line is negative. So Jay Powell is, to the president's point, stupidly, maybe to the market's point, stubbornly, not willing to cut rates, even though his own indicator that has been supported by his own researchers is suggesting that we could have a recession. And I would just throw one last thing at both of you here is, and looking at a number of different, looking at CRB raw industrials index or the oil prices or copper prices, and I do them in terms of gold to take the dollar effects out of there. The commodity market is telling you that perhaps the growth of the global economy is not looking particularly robust either. So this would be the argument, I guess, in favor of rate cuts. But Blaine, does that convince you? Does that compelling to you?
No, but that's the first thing that stuck out to me when you pulled this chart up is that this would argue for the case of a slowdown. Um, and I think in the face of increased tariffs, we even prior to that we were having talks of a little bit of a global slowdown. So maybe commodity prices are pricing some of that in, less transactional uh, between countries. I think all that's yet to be bared out. But yeah, that would be that. When I see this, that would be my first conclusion is, yeah, this is actually implying that the commodity markets are expecting somewhat of a large slowdown.
Tony, you've talked rightfully so about this acceleration of AI spend. I think I've seen some data that talks about how now it's like 42% of companies are spending. I forget the percent, but are spending an increasing percent on AI. And we've
Correct.
in the one big beautiful bill, there's full expensing of CapEx, which is going to help all of these companies that are spending on AI and I guess we don't call them data centers anymore. We've been told to call them AI factories, I think is what the administration is telling us to call them. Um, doesn't that argue for, yes, maybe a loss of white collar jobs, but maybe a gain in blue collar jobs as we build out these AI factories and the grid to support it?
Well, the issue is that even we build all of this kind of AI factory or data center, most likely the people working inside it will be robots, not
Yeah.
human, not us. So I do not see a major increase over the employment for the what people typically call the white collar job. Actually, white collar people might actually might be better off in the age of agentic AI because their job might not be replaceable so fast at this moment, especially in healthcare industry, in something maybe in even real estate or home improvement. This industry might not see the replacement impact as simultaneously, and those kind of a job currently in the upper high end. Earning upper high end salary might be the first group where we actually see the impact. So building the AI center and AI factory might help the local economy. That being said, maybe local government, local economy might be beneficial, but it might not just help the employment perspective. Even though maybe in the past people would say, "Hey, when we first have the car and before that people just ride horses, so you can either convert yourself from a horse rider to a car driver, right? This is one thing, or then the other, you can just become an owner of a business, like you can become a boss who actually asking the driver to do something. So that actually might not happen in this era where we actually see uh, the inequality over access to the capital and education become even larger and larger. That's what really concerns me.
Oh, that's a very fair point. I mean, you go from an equity analyst that's using Google to search to fill out your research report to using ChatGPT to search to do your research report, and all you're doing is using more energy.
Well,
But
exactly. And then you don't, and the robot will not ask for a salary increase, right? That actually will not contribute to the CPI anymore. This is, that's actually very good,
These are fair points. I just don't see them happening in 2025, and therefore I don't see the Fed cutting rates in 2025. I'm still not convinced. I think to me, the money market mutual fund at $7 trillion and
Yeah,
and the M2 data can ticking higher and higher suggests to me that there's plenty of money sloshing around in the system out there.
I think
Um,
so. I agree to some
and so I
extent.
think that to me is where you give the everyone who isn't running for the job like Waller is, everyone else is just kind of saying, oh, maybe we'll just wait and see. But Blaine, I'm gonna give you the last I'm gonna give you the last word on that one.
Ye- Yeah, no, I'm glad you brought these two charts back up because after you had shown that money market chart, and then your JPAL indicator. What's what's interesting to me is we're talking about mortgage markets and the Fed controls the short end of the curve and it doesn't really have a whole lot of impact on the longer end of the curve. But when you're Jay Powell and you're looking at, we talk about money velocity being lower than it historically is. Money market holdings are higher. Well, they're higher because, as you said, you can earn basically risk-free rate treasuries, north of 4%. I think 3-month treasuries, I don't know what, 4.3, 4.2, somewhere around there. I don't know exactly, but um, if the Fed starts to lower rates all of a sudden and it impacts that part of the curve, um, at what point does some of that money market funds come off the sidelines and look for alternatives? So that could impact asset prices. So then you have potentially asset price inflation, or you have that money being spent in the goods sector, and then you have goods inflation, which would impact CPI. And then they're kind of right back where they were, right? They're like, oh, now we've got, inflation somewhere in the system and we got to deal with that. So it's a bit of a conundrum, on when they go, but I think the wait and see approach to see kind of the data, pull through, I think is the right call here.
Yeah,
And to
Blaine,
me,
I actually want to comment on this point. This is actually very interesting. And what you just mentioned corroborated with what happened of the Japan in 1990.
Mm,
Where we actually see it as like a M2, so like continue going higher and higher.
Yep.
That literally just means that the the people, the Japanese, they do not spend.
Yes, exactly.
Apparently,
Yeah,
when they
yeah.
do not, when they didn't spend, just like, we are going to see the decreasing activity within the economy. So we are going to see recession. That's why um, the in Japanese since like a 1990 we call it the loss of decade. That was actually one thing is corroborating here that having the extremely high of the cash deposit might not be a good thing. So we actually from the Federal Reserve we want to avoid it. We don't actually want it like a way too low to cut the interest rate if because you wait too long, it's like the cash will just uh park over there and why simultaneously Gen Z and Millennium they actually will not actually have the affordability for the housing. You know, it's like you take maybe I think when they have to get the age of 37, Richard mentioned, correct me, age of 37 or even close to 40 to get to fulfill their American dream, right? In the past, whenever you got a job, that you can get a house realize the American dream, but today it
Yeah.
just becomes so difficult.
Yeah.
It seems like we have a bifurcated economy where you have baby boomers who have money market mutual fund assets and who
Yeah,
already own their house, who are doing very, very well. And you have millennials who are maybe working and saving and trying to get to a house, who
correct.
have lower rates. You have large cap companies who are sitting on cash, who are benefiting from higher rates and are going to benefit from CapEx spend and the taxing of that. And you've
Yeah,
got small companies that maybe need lower rates and lower regulation in order to get access to capital. So we continue to have this bifurcated economy where you have um, older people and larger companies that are going to do better, and you have millennials and smaller cap companies that are going to continue to lag behind. It would appear to me on that front, but maybe we can just leave it by what President Trump told us on a True Social tweet earlier this week. The GDP at 3%, that's the strongest GDP in a long time. So we better cut rates. I'll leave it at that.
Back
Um,
to the
okay,
economic
not
classes.
bad, not bad. But yeah, why leaving that? Just making sure that we continue to have an overweight of large cap tech. That's actually might still be doing the best in the current situation to benefiting from both high interest rate and simultaneous acceleration of the AI technology adoption.
as much as my contrarian and mean reversion instincts tell me that we should favor something other than large cap tech, I agree with you, Tony. It's hard to argue against large cap tech, right?
Sure.
So Blaine, last words, and then we're going to give it a wrap.
Yeah, no, I would just say I really enjoyed this conversation today, and I'm looking forward to the next couple months here and weeks. Just as we've got our own little maybe CFA Society of Chicago shadow fed going on here, and
Yes.
just it's just an interesting time, and it'll be good to catch up here in a few weeks. So thanks.
Yeah, I didn't realize Tony is playing that part of Shadow Fed, he's right now trying to get the job of Fed chair by being
Yeah, yeah, that's good. I'll be super excited. I'll
You're
be
right. We will get together in a couple more weeks.
yes.
Just how the data comes out, we'll be able to look and see how this jobs number that everyone seems to care about, even though we've gotten a dozen other jobs numbers this week,
Yeah,
how that comes out, and then more importantly, how earnings wrap up because earnings across the board,
yeah.
small or large cap, mid cap, and small cap earnings have all been better than expected. So even though
Right.
large cap tech is the place to be, earnings even in the small and mid companies have come in but much better than expected. Maybe another reason not to cut rates, but that's just me.
Yeah,
But maybe with that, we'll leave it there and we'll do a wrap on earnings and we'll set it up for what the Q4 will look like post Labor Day when we get together another couple weeks. So Tony and Blaine, great catching up. Thanks for joining me.
thanks,
Yeah,
guys. Yeah,
thank
a
you,
lot of
Blaine.
fun.
Thank you, Rich. Yes, look
Thanks.
forward to talking to you again. Okay, bye.
And thanks to all of our listeners. Make sure you like and subscribe so the algos pick us up and we can get more and more listeners, more and more downloads, and we can get more and more advertisers so that we can finally get a salary on this podcast. That would be nice, wouldn't it? Take care.